Hey, welcome everyone. This is Yield Talk, your monthly program on the fixed income markets. I'm Kathy Jones, Chief Fixed Income Strategist here at the Schwab Center for Financial Research. And today I'm joined by my colleagues, Cooper Howard and Colin Martin. This is going to be our last show of the year, and what we're going to do is highlight our outlook for 2026. So I'll kick it off with an overview of the landscape in fixed income. Then we'll go to Colin. He'll talk about the taxable market, and then we'll finish up with Cooper talking about the municipal market. As always, please remember this is for educational purposes only. They're not individual recommendations for your portfolio. We may change our minds and opinions at any moment based on developments in the economy or in the markets. So let's get going. The first slide, I'd just like to look back at what we've seen year to date here in 2025. We've seen pretty solid returns in the fixed income markets, actually very, very nice returns in the fixed income markets. Partly this was due to starting yields were high. The aggregate bond index, the Bloomberg Intermediate Term Aggregate Bond Index, which is sort of the benchmark that we follow, had a starting yield roughly around 5%. So that set the stage for good returns. And then we had some decline in interest rates over the course of the year to date, and that gave us some additional return. You can see there that international bonds actually had the strongest return of the sub-asset classes that we follow. That's primarily due to the weakness in the dollar. So the drop in the dollar helped enhance the returns there. But across the board, whether in the taxable market, the treasury market, or the municipal market, had positive returns for investors. Now, looking into 2026, would anticipate another solid year, but maybe returns won't be quite as robust. And the reason is that we're starting with lower yields to begin with, 75 basis points or so lower than where we started 2025. And there's probably less room for Fed easing as we go forward. And that probably means that we'll have positive returns. We should have positive returns because those starting yields are still attractive, still high enough to be a buffer for price changes, but probably not as robust as in 2025, at least a year to date. So let's dive in a little bit as to our view on why this is happening. We just had a Federal Reserve meeting, and as I'm sure you're all aware, the Fed cut rates again, another 25 basis points, and that brings the Fed funds rate, the lower bound, down to about 3.5%. If you look at their summary of economic projections, which is what's shown in the table here, it's a very optimistic view for 2026. They have growth picking up slightly, inflation edging down a bit, and the unemployment rate stabilizing at around 4.4%. Now that seems to me to be a fairly optimistic view, and I think it was emphasized by Fed Chair Powell as to what the committee is seeing, and that committee is seeing productivity growth. So Powell made the comment that he thinks that productivity, that is output per worker, has moved structurally higher. And in that environment, it allows the economy to grow a little bit stronger, despite, perhaps some constraints coming from tariffs and coming from other factors, and somewhat stronger without generating higher inflation, without an impact on the unemployment rate. So that optimistic view is what the Fed is communicating going into next year. But he also emphasized that there's probably less room for them to cut now. A lot of that has to do with where yields are today. The Fed funds rate, as I mentioned, lower bound down to 3.5%. The assumed neutral rate is roughly around 3 to 3.5% based on what the Fed has told us. Now, what is the neutral rate? That's the rate where the Fed is neither pushing up on the economy or pushing down on the economy. It's a theoretical rate. It's not an observed rate, but they know it when they see it is what they've told us. And so if you're close enough to the neutral zone, then the Fed doesn't have to do that much going forward. That is the interpretation provided by Fed Chair Powell. However, as you can see from this chart, this is the dot plot where each member of the committee puts a dot where they expect the Fed funds rate to be going forward over the next couple of years. As you can see, there's no real agreement here. We had a couple of dissents in this meeting with 2 members dissenting in favor of not cutting rates and 1 in favor of lowering them much faster. And as you can see, going forward, there's much less unanimity of opinion about where the Fed funds rate should be going. So although we got a pretty optimistic communication, we got a communication that tends to imply that the Fed is not in a hurry to cut rates again anytime soon. This is not an opinion that's widely held at the Fed. There's a huge dispersion of opinion. So we could see some volatility based on that, depending on how things play out. So FYI, just because this meeting said probably not much room to cut rates doesn't mean that there won't be rate changes going forward. And I would think that as we go forward, we'll see the Fed more divided than ever, and we'll continue to see this wide dispersion and some dissenting votes, which is a change from what we've seen over the past 10 or 20 years. But what it implies for returns in the market is pretty good, actually. Again, if we get a relatively stable Fed funds rate, maybe leaning towards a little bit of easing going forward, if that inflation comes in a bit, then we'll see returns in the fixed income market should be pretty positive. Okay, so let's dive in a little bit deeper into what drives that Fed policy. The key is going to be the labor market. Now, we've had a lot of noise in the labor statistics because the lack of data due to the government shutdown has left us with some very unstable numbers, and we'll be catching up, but there's going to be just some holes in the data, which makes it more difficult to interpret. What we've seen recently is after coming down pretty sharply, non-farm payrolls, a job growth monthly, picked up in the last month. Now, again, we've got some catching up to do. This is based on the establishment survey where they survey businesses. The household survey actually saw some softness. So it's a real uncertain where employment is going in the near term. Some of the other indicators we get, the private sector, seem to signal further softening. Fed Chair Powell referred to that during the press conference after the Fed meeting, saying that they do expect some downward revisions to the data. So I think the Fed's view is that the labor market is still soft and softening, and that justifies an easier policy. And that will probably be going into 2026. The watchword at the Fed is keeping an eye on the labor market statistics. That will drive expectations about what the Fed will do going forward, whether there'll be more cuts sooner rather than later, or whether they hold steady for much of the year. So keep an eye on that. Our general expectation is there has been some softening. We've seen it in the data, but it's going to take a while to catch up and get a good, clean reading. The second factor, obviously, the second part of the mandate for the Fed is inflation. So their job is to aim for low inflation at 2% and full employment. The inflation readings are not cooperating right now with the Fed. As we all know, inflation remains elevated above the level that the Fed wants, the target level of 2%. It's been closer to 3% for much of the last couple of years, and obviously was much higher coming out of the pandemic stimulus. And this is going to be a challenge, I think, for the Fed, in that if we get the kind of economic growth that the Fed is talking about, even with productivity, it may be hard to bring that inflation rate down. So we're cautious about the pace of rate cuts going forward. And we think that there is a risk that the inflation numbers really don't provide much opportunity for further rate cuts in the near term. We're looking at the tension between the two mandates that the Fed has. One is for full employment. We're seeing some deterioration in the job market, but the other is for low inflation, and we're not there yet. So that probably is going to mean they tread carefully, and the market's going to be a little bit tense about that. I wouldn't expect any big moves in either direction until something breaks one direction or another. So what does that mean for the market? When we look at the Treasury market as, sort of a read in terms of where we expect yields to go, we're looking for the steeper yield curve. We have been talking about this for the past year or two, and it has been steepening. That is, short-term rates relative to long-term rates, that difference has widened and continues to widen. We think that that will continue as a trend in 2026. Again, maybe not that much room for long-term rates to come down, not only because inflation is elevated and the Fed may not have much room to lower rates, but long-term rates are also driven by expectations for economic growth and inflation, as well as the term premium, what we call that risk premium that investors demand to hold longer-term debt. And what we're seeing there are a couple of factors that may keep longer-term rates elevated. One is the reluctance of inflation to come down. The second is supply. We're seeing high and rising fiscal deficits that will keep the supply of Treasury issuance high. That has to be absorbed by the market, all else being equal. Investors may demand a little bit higher premium to hold longer term bonds because of the uncertainty about that heavy supply coming down the road. We're also going to be seeing some supply on the corporate side because we're seeing so much corporate investment, and Colin will talk about this, but heavy issuance by corporations for investing in AI. They're getting tax credits to do this. That will probably keep supply pretty heavy in that part of the market as well. And then we're seeing the fiscal stimulus on top of high and rising deficits. We have some fiscal stimulus that will come through for consumers in terms of tax credits. So all that combined, yes, the Fed may be right that economic growth remains robust, but that means we're probably going to see somewhat higher yields, or at least very little room for longer term yields to come down in the near term, even if the Fed lowers rates. And that keeps that term premium moving higher, and it keeps that spread between short and long-term rates expanding. So that's the primary trend we see continuing in the market going forward. Just to sum up real quickly, maybe a little bit of room for further easing by the Fed, but not that much anymore. Still tension between the labor market and inflation, and rising term premium, keeping longer term rates higher and steepening the yield curve. And with that, I am going to pass it on to Colin Martin for his comments on taxable bonds.
Great. Thank you so much, Kathy. You really laid out the groundwork for how we can take those views and talk about some more potential opportunities, maybe some pitfalls in the taxable credit markets. I want to dig in a little bit about 2025 performance. And Kathy, you touched on this kind of in your intro about how 2025 has generally been a good year for bonds. And part of that, and a lot of that, had to do with just the high starting yields and the income payments that bond investments provide. So I want to dig into that on the corporate bond side of the equation. But first, I want to talk about the difference between yield and total returns. We know a lot of investors focus more on the yield offered on a bond investment and what that means over time in terms of income earned and how over time, what will my annualized return look like? We do look at short-term returns. So that chart that Kathy showed and what I have up here is a year-to-date return. You can have good years and bad years because bond prices can fluctuate in the secondary market. And so what we saw this year is not just the income payments that have driven return, but there's also been some price appreciation for most bond investments. But as you can see on this chart, not all bond investments. And what sticks out here is that the higher rated parts of the bond market, so investment grade corporates and US Treasuries, which are kind of the middle part of this chart, have had higher price returns than the riskier parts of the market, like high yield corporate bonds on the left and bank loans and preferred securities on the right. We think this sort of trend can continue next year, mainly due to, I'd say rising risks in the credit market, an increase in the default rate, or even just a default rate holding steady. Because if issuers default, and when there are bond defaults, they're at the lower rungs of the investment grade credit spectrum. They're generally from high yield bonds and bank loan issuers. So some sort of credit loss can pull down the price appreciation. Now, the starting yields can help deliver positive total returns, but it makes the potential outperformance a little bit trickier as we look ahead for 2026. So Kathy talked about the idea of intermediate term maturities. Our main other piece of guidance is to focus really on higher rated parts of the market, specifically investment grade corporate bonds, and then consider things like preferred securities, high yield bonds, bank loans more in moderation, because we do expect a little bit more volatility there. Now, if we go to the next slide, we'll talk about the opportunity that we see in yields. And we still think there is an attractive opportunity with the more highly rated parts of the bond market. So this chart's similar to what I just showed, where we have high yield bonds, preferred securities, investment grade corporates, and then treasuries on the right. And I looked at the range over the past 15 years of the average yield to worst that each index has offered, and then kind of showed where we are today. We'll focus first on the left, high yield corporate bonds. One, you see a very wide range. That's because when there are periods of market volatility or recessions like we saw in 2020, the yields that they offer tend to rise pretty sharply. So you see a wide range there. But high yield corporate bond yields today are kind of at the lower end of the range. And if we look at the 15-year average, they're actually below the 15-year average. So for long-term investors, the opportunity just doesn't look relatively attractive compared to where we've been over that 15-year time frame. Now, if we look at the right three columns or ranges, we can see yields that are still near the upper end or upper half of that 15-year range. And so I'll focus more on investment grade corporate bonds. Yields on average close to 5%. Yes, they're below their highs from 2023, but well above their lows, and they're well above that 15-year average. So for investors, specifically those, or more importantly, those in tax-advantaged accounts, because investment-grade corporate bond interest payments are fully taxable, you can still get yields in, say, 4.25% to 5.25% range on average between, given the mix of maturity and credit ratings that you're looking at. We think that's attractive, especially where we were relative to the past 15 years. And if we look at the next slide, we think the slope of the investment grade corporate bond curve is attractive as well. When we talk about yield curves, it's really just the line that connects the yields of different bonds by maturity. So here we have the Treasury yield curve and the A-rated and BBB average yield curves. You can see that for corporate bonds, it's a little bit more positively sloped, especially once you get to that intermediate term part of the yield curve, say that 5 to 10 year range. Now, there's more risks, of course, by considering a portfolio of 5 to 10 year corporate bonds relative to, say, treasury bills or money market funds. There's more credit risk, there's more interest rate risk, meaning more volatility. But if you have a longer term investing horizon, we think intermediate term corporate bonds can make a lot of sense given those yields I just mentioned. Specifically, if you look at 10-year maturities, for example, if you can get close to 5% yields, we think that's attractive if you have that longer term time horizon, because if you are focused more on shorter term investments, whether it's money market funds, treasury bills, CDs with maturities of 12 months or less, if our outlook comes to fruition and if the Fed gradually cuts rates like Kathy alluded to, the income payments on those investments should continue to decline. So we like intermediate term where you can lock in some higher yields and more sticky income that won't necessarily decline as the Fed cuts rates. On the credit quality side of the equation, we're comfortable with the credit risk of investment grade corporate bonds. Depending on the actual credit rating itself, low to moderate credit risk. Even though we've have concerns about the tariff impact on corporations, things like that, for the most part, corporate profits remain very, very high right now. So investment grade corporations are well positioned, we think, to kind of navigate a more uncertain environment. And the credit quality of the investment grade universe has been improving over the past few years. We've seen the share of single A rated corporate companies, single A rated bonds, that share rise in the corporate bond index at the expense of triple B rated bonds. We look at the investment grade credit spectrum, it goes from triple A, double A, single A, and then triple B. Triple B is the lowest rung. We've seen that share, the triple B share, decline, and we've seen the single A share rise. So that's a good thing. It means the fundamentals of the issuers in that corporate bond index have been improving. Now, if we do move to that next slide, we're a little bit more cautious about high yield bonds. So high yield bonds are issued by corporations, but they have sub-investment grade credit ratings. Those are double B or below. And they have those lower ratings because of the increased credit risk, maybe more volatile cash flows, maybe more debt relative to their earnings, so more leverage. And they have lower ratings, and therefore they offer higher yields to compensate for those risks. Except today, those higher yields, those relative yields, are low. This chart looks over the past 20 years of the extra spread or extra yield that high yield bonds on average offer over comparable treasuries. We're less than 3% right now in mid-December, and we've really been at or below 3% basically since the summer. On this chart, we break out a few different kind of cohorts of that credit spread. In red, we have 3% or below. In gold, 3 to 5%. In green, 5% or more. And we looked at a starting investment or looking at the index when yields were in those little buckets and what the excess return over treasuries was over the next 12 months. I want to focus more on that red area. And when spreads are this low, 39% of the time, the high yield index has outperformed treasuries. That's relatively low, so less than half the time. So they come with higher yields, but the price volatility and potential declines when spreads are so low means that the potential for outperformance is relatively low. Now, if you're a long-term investor and you're willing to ride out some ups and downs, then high yield bonds and other riskier investments like bank loans can be considered in moderation, but we don't suggest an overweight right now. Because even though the, say, 6.5% to 7% average yields that high yield bonds offer, prices can go up and down. They tend to be more volatile. So you need to really be ready to ride out those ups and downs. And we'd wait to see these spreads that we have on this chart here, the relative yields, the risk premium that we as investors earn by investing in and lending to these riskier companies. We'd rather see that spread move up a little bit before we got a little bit more excited about a more tactical position with high yield bonds. And finally, let me touch on preferred securities before we bring Cooper in. Preferred securities are sort of a niche investment. They have characteristics of both stocks and bonds, but we tend to focus on them because they are an income-producing investment. And we think they're relatively attractive right now, but we have a similar outlook that we have with high yield corporate bonds, in that you need to really be ready to ride out the ups and downs, mainly because they have very long or no maturity dates at all. That's a key characteristic with preferred securities. A lot of them are perpetual in nature. Now, they have a call option usually at the issuer. If it makes economic sense, the issuer might retire them or decide to retire them. But absent that call, some issuers just might allow them to be out in perpetuity. And that in and of itself presents a risk, because you don't have a specific date you can look to where you'll be repaid your maturity or repaid your principal at maturity. So we always suggest preferred securities investors have long-term time horizons. Now, from a long-term entry point standpoint, we think they're relatively attractive. You can see on this chart, we go back 15 years or so, and we look at the average price of the ICE B of A fixed rate preferred securities index. It's mostly investment grade rated fixed rate preferreds. Maybe there's some double B rated issuers, the high end of the junk spectrum. After the Fed began to aggressively hike rates, we saw the price of this index, the average price, fall. So from a long-term standpoint, the entry point looks relatively attractive, but just even recently, you can see there's a little downtick. And that is not something we saw with other parts of the market, even specifically long-term treasury yields. When you're considering preferred securities, sometimes they have a strong relationship or a tight relationship with treasuries. Sometimes they have a relationship with the stock markets. You need to be ready for them to kind of act in a few different ways. And we think that the recent price declines are likely due to the credit concerns I mentioned before as it relates to elevated defaults, maybe souring loans at banks and other financial institutions, because most preferreds are issued by banks and financial institutions. And the idea that we've seen some delinquencies pick up on the consumer level, or seeing consumers maybe having a hard time getting that credit, that can flow through to financial institutions. So I think that's weighing in a little bit. But from a long-term standpoint, we think the entry point's relatively attractive. And I think this will be a good segue when we get to Cooper. A really great, a really nice characteristic and benefit to preferred securities is that a lot of them pay qualified dividends, or dividends that are taxed at a lower rate than traditional interest payments. Now, not all preferred securities pay qualified dividends, so you always want to do your homework or work with a professional to help identify those securities or strategies that focus there. But on an after-tax basis, when you look at those preferreds that can pay the qualified dividends on an after-tax basis, they might offer higher yields than high-yield bonds, but with higher credit ratings. Now, they have slightly different risks because they're more long-term securities, but on an after-tax basis, we think preferreds look a little bit more attractive than high-yield bonds. So something to consider if you're looking for more income, willing to take a little bit more risk. We think preferred securities could be an opportunity. So with that, let me pass it to Cooper to hear about our municipal bond outlook.
Thank you very much, Colin. Also, thank you, Kathy, for setting the stage. I'm going to kind of build on a lot of what Kathy had discussed, also build on a lot of what Colin had discussed. But first, I want to roll it all the way back to one of the first slides that Kathy shared. And this is looking at total returns. And the point that Kathy had made, which is correct, is that total returns for most fixed income asset classes that we track have been very positive. They've been a very good year. However, all the way at the bottom of the chart here, you can see is the municipal bond market. So we've shown both investment-grade municipal bonds as well as high-yield municipal bonds. Yes, they are positive returns, but they are trailing most other fixed income asset classes. So it's been a good year for the muni market, but not as good as some of those other parts of the market. A lot of the reason for that is the issuance side of things. So when it comes to the muni market, there's a supply and demand dynamic to it. And this kind of harkens back to, if we would think about economics 101, supply and demand. If you get greater supply, then that's going to cause prices to move down a little bit. And looking at total returns, because as Colin had shared, total returns are a combination of changes in prices plus the coupon income that you receive. Those total returns haven't been as strong for other parts of the market. And that's because, like I'm showing here, that issuance side of things has been very strong in 2025. So you could think, well, why has that been very, very high? There's a couple of reasons why many municipalities are choosing to issue debt in this environment. Part of the reason is, one, issuing muni bonds is usually used to fund infrastructure projects. Those infrastructure projects, due to higher inflation, like Kathy had mentioned, is just higher now. So those are costs that they have to bore, and therefore they have to issue more debt to absorb those costs. The second piece about it, tying it into this year, is that in 2025, if we think back to the beginning of the year, or if we think back to actually July, the One Big Beautiful Bill Act was passed. And in that bill, there were some concerns that maybe the municipal bond tax exemption would be repealed, because munis pay interest income, or generally pay interest income, that's exempt from federal income taxes and potentially state income taxes. Now, it never came to fruition, but there were some concerns early on that maybe that tax exemption status of municipal bonds would be repealed and they'd have to issue taxable bonds going forward. That never came to fruition. That never happened. But many issuers rushed to market to get deals in ahead of time. Now, the other reason that we also saw a significant amount of debt issued this year is there's been a large amount of voter-approved debt going back a few years. So when there's a election cycle, it tends to be that individuals are asked if a municipality can issue debt, they can increase their debt limits, and then over time, they can choose to issue into an environment that they want. So that's the three main reasons why we've seen an increase in debt this year. Now, I do expect that that's likely going to continue into 2026 because really two of those three reasons aren't going away. First, issuers are still having a large amount of voter-approved debt that they're sitting on and the ability to issue that. Second, like Kathy had mentioned, it's not like inflation is going to move significantly lower or even deflation to where infrastructure costs are going to become cheaper. So I would expect that we're going to continue to see a large amount of issuance going forward. Now, you might also be asking, well, does that mean that we would expect that there would be negative total returns from municipal bonds, or do we not think that they're an area of opportunity? That's not correct. We do think that they are an area of opportunity. And if we look at the muni market, the way I like to kind of consider and think about the muni market is there's really two things that the municipal market can hang its hat on. The first is attractive tax-adjusted yields, and the second is high credit quality on average. So if we look at the first thing that the muni market can hang its hat on, are we seeing attractive tax-adjusted yields? Yes, we are, in my opinion. And you can see here, what we've shown on this chart is just a simple tax-adjusted yield for a broad index of municipal bonds. So if you go out and you look at the yield to worst on the Bloomberg Municipal Bond Index, which that's a broad index of munis, has all investment grade issuers, some shorter term, some longer term, some lower rated, some higher rated. On average, that pays about 3.6% before adjusting for taxes. And that's the key here, before adjusting for taxes. Because like I mentioned earlier, munis generally pay interest income that's exempt from federal income taxes. So if we were to adjust that for a bond that would be fully taxable for an investor in the top tax bracket, that's an over 6% yield. And you can see that going all the way back about 2 decades, that's fairly attractive to where we have been historically. It also stacks up fairly nicely to some of the yields that Colin was mentioning with the corporate bond market. But it is important to note that this isn't an apples to apples comparison because there are differences in credit quality. There's also differences in maturities. But if we kind of dig into the other areas of opportunity, one of the areas of opportunity that I think is looking at the yield curve itself. And what we've done here is we've taken the yield curve for just a generic index of AAA municipal bonds. Those are the highest rated rung of investment grade credit quality, and compared that to a yield curve for treasury bonds after adjusting for taxes. And we've adjusted it for an investor who's in the top tax bracket. So if you're not in that top tax bracket, things would look a little bit different, but the point is still going to apply. And the point is that as you begin to move out the yield curve, and if you focus in on the right-hand side of this chart, you can see that the difference in yields between treasury bonds after adjusting for taxes and municipal bonds begins to get higher and higher the further out you go. Now, one of the points that Colin had made is that we generally think that most investors should focus on an intermediate term duration. That also applies to the muni market. So even though you can get a higher yield relative to treasuries by moving out the yield curve, we don't think that investors should be investing their entire portfolio in 20 or 30 year or very long-term maturities. One of the reasons why is that, one, you're locking up that money for a very long period of time, and so you might be missing out on some opportunity costs. But also another very important reason is that longer-term bonds tend to be much more sensitive to changes in interest rates. So if yields rise, the prices of longer-term bonds will fall much more than relative to shorter-term bonds, and your total return for longer-term bonds would likely be much worse than that of short-term bonds. So we do think, yes, most investors should stick to an intermediate term duration. However, that doesn't mean that you should only focus on 5 to 7 year bonds, for example, or 5 to 7 year maturities. That means a combination of some short and some longer term bonds. And if you are an investor who is in a higher tax bracket, then I do think that longer term municipal bonds are worth a consideration if you have a higher risk tolerance for interest rate risk and if it fits into your plan. The second piece that I'd like to look at is that other part of how munis can, or what can munis hang their hat on, and that's stable and high credit quality. And in fact, over the past couple of years, what we've seen in the muni market is credit quality that's been improving. Like Colin had mentioned, credit quality in the corporate market has been improving. That also applies to the muni market. Part of the reason why is coming out of the COVID crisis, that was really a game changer for the muni market. It was kind of a turning point, I should say, in the muni market. And a lot of the reasons why is because many municipalities received a significant amount of fiscal aid. They also saw a surge in their tax revenues. And what they did with that excess money is they socked it away. So municipalities, states have what's called a rainy day account, and that's akin to a savings account for you and I. And what I'm showing here is what did rainy day funds look like prior to the 2020 COVID crisis, 2019, relative to where we were in the last fiscal year, 2024. And what I want you to focus in on is the very left-hand side of this chart. So this is showing how many states could run off of their rainy day funds alone for how many days. All the way on the left, it shows that 23 states in 2019 could run between 0 and 50 days on their rainy day funds alone. So fast forward to where we were most recently, and you can see that a lot of those blue bars that were in 2019 in between 0 and 50 or 50 and 100 days shifted out all the way to the right and are now the gold bars in 2024. So what that means is that more states built up their rainy day funds and they can run off of that if necessary, if there's a slowdown in revenues. So the point being is that even if we do see a slowdown in the economy, and that's not our base case, given that municipalities have generally built up their liquidity positions, they can tap into this, and that should help credit quality going forward. So we don't expect that there's going to be a significant deterioration in credit quality, and we do think that second tenet of high credit quality should be something that should continue into 2026. So we do think that for those investors who are in higher tax brackets, municipal bonds can be worth another look or worth consideration. Now, that really wraps up kind of the main points that we've covered today and the main points of our 2026 outlook. I know we've covered a lot of information. We've covered some terms that might not be familiar. So one of the resources that I do want to highlight is our frequently asked questions. And this is directly on the website, and I'll include a link here. We'll show a link on the slides. So if this is something that you wanted to take a picture of or jot down, I do think this is a very good place to go if you do have questions about one of the terms that we had mentioned, or maybe one of the strategies or one of the investment opportunities. This is something that can help explain that. So we are going to wrap it up there. That's our last show for 2025, but that's not likely the last that you'll hear or see of us. We're always going to be publishing materials directly onto schwab.com or potentially going out into branches and meeting directly and giving presentations to clients. So I'd really like to thank everybody for tuning in. Thank you for a good year of following our content and continue to follow along. So thank you very much.